Yeah, believe it or not, two of the other five top picks are actually up for the year. One is the USO, that's up about 12%. The other one's the regional bank index, that's up 1%. So cash is actually our third best right now. Now, to your question on have we deployed some, the answer is actually we did deploy some today. We actually took 10% of the cash in the portfolio and we put it into a basket of small cap stocks today in the Russell 2000. We also put about 5% of that cash to work in regional banks, which we had sold before the start of JP Morgan's results, because if you look at it statistically, and we can get into the reasons why, but banks always tend to go down statistically during that reporting period, starting with generally JP Morgan's results, and you typically get a better spot to buy them. So we got lucky, I guess, and so we were able to buy some of that today. And in general, we still actually have, even with putting 15% of our cash to work, we still have a lot of cash in the portfolio. So we're looking to deploy that going forward. I think the next 3 to 5% move in the S&P is up, not down. I think the next 10% move, though, is still lower. But a lot of things got very oversold today on the 17 technical metrics we look at. So as much as I hated doing it, given, you hold the stocks over the weekend, we started putting a lot of money to work and covered a bunch of shorts latter part of this week.
And so talk us through what gave you confidence to do that. I totally get that it's only 15% of your cash you put to work, and that you do still think there'll be another pullback in a few days or a few weeks. But what gave you confidence that we're about to have a short-term bounce?
Well, as I said earlier, and I think we may have tweeted about these things before, but there's about 17 technical measures we track. And I think, emotions are horrible for investing in the market. You kind of want to be selling them when everybody's euphoric and buying them when everybody wants to throw themselves out a window. And, there are different things we look at. Amount of volume, that was up tremendously today. The volatility index, the VIX spiked, getting close to 30. You look at the number of down stocks relative to up stocks. Percentage within Bollinger Bands. There's a whole bunch of different things, but we had a lot of different things we look at: percentage of stocks at 52-week lows, getting to levels where you go, there's a lot of panic in the market. But if you look at today, you go, well, what really happened? Well, Netflix missed now the third quarter out of the last four. So you go, yeah, we knew there was pandemic give back. Peloton had another problem. E-commerce sales are bad. And so you're not learning a whole lot of new stuff. The only thing you had happen was a whole bunch of analysts finally throwing the towel and go, yeah, you know what, I guess there is some issues with the pandemic and there is still some give back. But, don't forget last year, Netflix stock was up despite missing, the June quarter and the March quarter. And don't forget that follows Amazon being up last year, missing 2 quarters in a row as well. And so this is sort of continuation. The big difference is the Fed and inflation, which is the Fed's going to be jacking rates this year, working down their balance sheet, because funnily enough, it's not even the 10-year treasuries. 10-year treasury yields were actually down, I think, 2 or 3 basis points this week. So you can't even blame that for what's going on with the tech stocks or the sell-off in the market. So it's a combination of things. I mean, we'll see if today was the bottom. You're always scared about, the worst crashes in history have typically been bad week, bad Friday. Guys go home over the weekend, and Monday they just come in and there's wholesale selling. So you have to be concerned about that, but that's why we look at technicals to try to take emotions out of it.